In 1720, the most respected financial minds in Europe held pieces of paper that they believed represented the future of global trade. They were not fools. They were not gamblers. They were sophisticated investors in the Mississippi Company, a system engineered by the most brilliant economist of his era, backed by the French crown, promising returns from an entire continent's untapped wealth. Within 6 months, those pieces of paper were worthless. The system had not failed by accident. It had reached the logical end of a structure that could only be sustained as long as confidence held. Right now, there are 3 specific signals inside the Federal Reserve's own behavior: its policy decisions, its institutional preparations, stress test scenarios that suggest confidence is no longer something those in power are taking for granted. They are preparing for something. The question is, are you? There is a particular quality to the silence that precedes a financial collapse. It does not feel like danger. It feels to almost everyone living through it like stability. In the autumn of 1929, the United States was the most prosperous nation in the history of the world. The Dow Jones had risen 500% in less than a decade. Respected economists were publishing papers with titles like "The New Era of Permanent Prosperity." The President of the United States said, just months before the collapse, that America was nearer to the final triumph over poverty than ever before in the history of any land. Then, on October 29, 1929, the system broke. Over the following 3 years, American equity markets lost 89% of their value, banks closed, family with $100,000 in stocks, an extraordinary sum, equivalent to roughly $1.8 million today, would watch that shrink to $11,000. The Federal Reserve had seen it coming, not all of it, not the precise timing, but the fragility was visible in the data. This is the first lesson of financial history. Knowing a collapse is approaching is not the same as being able to prevent it. And the institutions that know the most are sometimes in the most impossible position. If they say what they see, they trigger the collapse. If they stay silent, they are complicit in the damage. So they manage, they adjust, they reposition quietly. Move forward to Tokyo in December 1989. Japan's Nikkei index sat at 38,915. Japanese real estate had become so expensive that the grounds of the Imperial Palace in central Tokyo were estimated to be worth more than all real estate in the state of California. The Bank of Japan raised rates. Officials knew the market was overextended. They intended a controlled deflation. What they got was something that took 34 years to recover from. The Nikkei lost 80% of its value. Japan coined a new phrase for what followed, the lost decade. Then it became 2 and 3. Then came America's own warning in March 2000. The Nasdaq peaked at 5,048. By October 2002, it had fallen to 1,114, a 78% loss, roughly $5 trillion of wealth. Real retirement accounts, real savings, real college funds had been erased. Not transferred, erased. 3 collapses. 3 moments of visible, documented excess. 3 situations in which the most powerful financial institutions in the world had access to the warning signals and could not stop what was coming. We are in 2026, and the signals are appearing again. There are 3 specific signs embedded in Federal Reserve policy, in U.S. debt mechanics, and in the Fed's own institutional positioning that suggests something is being quietly prepared for. Not publicly announced, not acknowledged in press conferences, but visible, clearly, to anyone who knows where to look. This is where we look. On October 19, 1987, the Dow Jones Industrial Average fell 22.6% in a single day. Not 2.6%, not 12.6%, 22.6%. In one trading session. It's the largest single-day percentage decline in the index's history, before or since. There was no single triggering event that most people understood at the time. What had broken was not a company, not a policy announcement, not a piece of economic data. What broke was the hidden mechanical structure of the market itself. Portfolio insurance strategies used by institutional investors to protect large equity holdings had created a feedback loop. Under sufficient selling pressure, the strategies automatically generated more sell orders, which generated more selling pressure, which triggered more automatic sell orders. The loop fed on itself until it produced a result that no individual participant had intended or anticipated. The Fed flooded the system with liquidity overnight. The market stabilized, and the official narrative that a technical glitch had been corrected obscured the deeper truth, that the system had revealed a hidden fragility. The fragility had not gone away simply because the acute crisis had been managed. This is the mechanical reality of what financial historians call a 10x wipeout. It does not announce itself. From the inside, it looks like a correction until the moment it doesn't. Consider the case of MF Global in October 2011. MF Global was a major regulated broker-dealer, led by a former U.S. Senator and Goldman Sachs CEO. It was supervised by regulators. It was audited by accountants. Its clients had been told their funds were held in segregated accounts, legally required to be kept separate from the firm's own money. When MF Global filed for bankruptcy, $1.6 billion of client funds was missing. Those clients had done nothing wrong. They had trusted a regulated, supervised, publicly accountable institution. They lost their money permanently, not temporarily. It's not in a recoverable way. Gone. The Confederate dollar of the American Civil War offers a different kind of lesson, the lesson of a currency whose end was not sudden, but inevitable. By early 1865, Southern civilians had watched their currency lose 90% of its purchasing power over 4 years of war. The Confederate government printed money to fund a war it was losing. The money supply increased, prices rose, confidence fell, more money was printed to compensate. By the time Richmond fell in April 1865, a Confederate dollar was worth less than the paper it was printed on. Not because of any single event on any single day, but because the structural logic of the system had only ever had one possible ending. The pattern across these three examples, the 1987 crash, the MF Global collapse, the Confederate dollar, is the same pattern that runs through every financial wipeout in recorded history. Hidden fragility accumulates during a period of apparent stability. A trigger event, technical, institutional, political, surfaces the fragility. The cascade begins. And by the time ordinary people understand what is happening, the losses have already been taken. Understanding this anatomy is not academic. It is the difference between recognizing the current signals for what they are and dismissing them as pessimism. So what are the three signals? Let's examine each one with the precision that the evidence demands. On January 3, 2001, the Federal Reserve held an emergency, unscheduled meeting and cut interest rates by 0.5 percentage point. The Nasdaq had already fallen 45% from its peak. The dot-com bubble had clearly burst. The Fed's cut was presented as a stabilizing measure. Over the following 12 months, the Fed cut rates 10 more times, bringing the federal funds rate from 6.5% down to 1.75%. During that same period, the Nasdaq fell another 60%. The rate cuts did not stop the collapse. They accompanied it. This is a fact that almost every mainstream financial commentary glosses over, because it creates a deeply uncomfortable conclusion. A Federal Reserve rate cut is not inherently a signal of stability. Historically, it is one of the most reliable indicators that the worst is either already underway or directly ahead. Not because rate cuts cause collapses, but because they confirm that the Fed sees enough danger in the system to override its normal caution. Central banks do not cut rates when they believe everything is fine. They cut rates when they believe something is breaking. The pattern is consistent. Before the 2008 financial crisis, the Fed began cutting rates in September 2007, 12 months before Lehman Brothers collapsed. Before the 1990 recession, the Fed began cutting in June 1989. The economy entered recession 6 months later. Before the 2001 recession, the cuts began in January of that year, and the recession was already technically underway. Paul Volcker is the exception that proves the rule. Between 1979 and 1981, Volcker raised rates to 20%, deliberately inducing a severe recession to break inflation's grip on the American economy. He accepted the political consequences. He was explicit about the pain he was inflicting and why. It worked. Inflation fell from 14.8% in 1980 to 3.2% by 1983. The reason Volcker matters here is precise. The Fed's 202-22-023 hiking cycle was described as the most aggressive since Volcker, Rates went from near zero to 5.25 to 5.5%. The stated purpose, defeating inflation, was the same as Volcker's. But in September 2024, the Fed began cutting. Not because inflation had been fully defeated, not because the economy showed severe distress, because something in the credit system required a response. The yield curve confirms this reading. The yield curve, the relationship between short-term and long-term interest rates, inverted in 2022. Yield curve inversion has preceded every U.S. recession since 1970. Every single one. The 2022 inversion was the longest sustained inversion in recorded U.S. history. And the recession that follows an inversion does not typically arrive during the inversion. It arrives in the 12 to 18 months after the curve uninverts. The U.S. yield curve began to uninvert in late 2024. That 12-to-month window points directly into 2025 and 2026. The Fed's September 2024 rate cut is sign number one. Not because rate cuts are always catastrophic, but because every data point, the yield curve, the timing, the credit market signals, historical precedents suggest the cut was made not from strength, but from a recognition that something had already begun to fracture. And when the Fed cuts into a system carrying the debt load we are about to examine, the historical record is not reassuring. In the spring of 1557, King Philip II of Spain controlled the most powerful empire in the world. Spanish galleons commanded the Atlantic. Silver from the mines of Potosi was flowing into Spanish ports at a rate Europe had never seen. The Spanish military was unmatched. That same spring, Philip II defaulted on Spain's national debt. It was not the last time. Spain defaulted again in 1575, then 1596, then 1607, then 1627, then 1647. 6 defaults in 90 years. It's the richest empire in the world, drawing on an entire continent's silver. Repeatedly found itself unable to pay its creditors. The reason was structural. Silver did not make Spain wealthy in the deep sense. It made Spain dependent. Constant inflows of silver allowed the crown to borrow against future revenues, fund campaigns that current income could not support, to maintain an elaborate imperial apparatus without the discipline that scarcity enforces. The debt grew. The interest payments grew faster. By the mid-1600s, debt servicing consumed most of Spanish government revenue, leaving almost nothing for the investment that might have extended the empire's life. Now, France in 1788, the French government was spending 60% of its total annual revenue on servicing existing debt, not reducing it, not paying it down, simply keeping current on the interest. The remaining 40% had to cover everything else: military, administration, the royal court at Versailles, the entire machinery of the French state. The math was impossible. Every finance minister who examined it knew it was impossible. The solution required taxing the French nobility. The nobility refused. The result was the convening of the Estates General in May 1789, which became the French Revolution. A debt crisis does not stay in the financial system. It bleeds into politics. It bleeds into society. It creates conditions in which things that seemed impossible during the years of stability become inevitable. The Austrian krone of 1922 offers a compressed version of this lesson. Austria, devastated by the First World War and saddled with reparations and a collapsed empire, found its government borrowing overwhelming the credibility of its currency. The krona lost 99% of its value in under 2 years, not because Austrians were irresponsible, but because the arithmetic of their debt had reached a point where no policy adjustment could restore confidence faster than the market could destroy it. Now, the United States in 2026, U.S. national debt has crossed $36 trillion. The federal government is now spending more than $1 trillion per year, $1,000 billion simply on the interest payments. Not reducing the principal, just keeping current. That $1 trillion in interest payments now exceeds the entire U.S. defense budget. It is the single largest line item in the federal budget, and it is growing at a compounding rate. The trap is mechanical. Approximately $8 trillion in U.S. Treasury debt issued at near-zero interest rates is now maturing and must be refinanced at current rates of 4% to 5%. Debt that cost almost nothing is being replaced by debt that costs 4 to 5 times as much. The interest burden, already record high, is about to become significantly heavier. Meanwhile, the traditional buyers of U.S. Treasury bonds are stepping back. Japan reduced its holdings while defending the yen. China cut its treasury position from $1.3 trillion in 2013 to under $800 billion by 2024. Saudi Arabia has begun diversifying. Who is buying the bonds these major holders are selling? Increasingly, hedge funds and other non-traditional buyers, far less stable in their commitment than the sovereign holders they are replacing. Spain was the greatest power of the 16th century. It defaulted 6 times. The arithmetic of compound interest makes no exceptions for great powers. The United States has arrived at stage 4 of the debt collapse pattern, the moment when creditors begin demanding higher yields to compensate for increasing risk. Stage 5 currency pressure is not theoretical. It is next. On August 9, 2007, the Federal Reserve described the U.S. economy as fundamentally sound. Ben Bernanke told Congress that risks in the subprime mortgage market appeared likely to be contained. 13 months later, Lehman Brothers collapsed, and the global financial system nearly stopped functioning. Between those 2 dates, the Federal Reserve was doing 2 things simultaneously: publicly managing expectations and privately preparing for the worst. This is not an accusation. It is a structural reality of central banking. A central bank that acknowledges the full extent of systemic risk it perceives cannot perform its most important function, maintaining confidence. If every depositor withdrew simultaneously, every bank in the world would fail. The system works because most people believe it will continue to work. So you cannot read the Fed's public statements and understand what the Fed actually sees. You must examine its institutional behavior. And the behavior of 2023, 2024, and 2025 tells a very different story than the press conferences. In March 2023, Silicon Valley Bank, the 16th largest bank in the United States, failed in 48 hours. Customers initiated $42 billion in withdrawal requests in a single day. The Fed's immediate response was the Bank Term Funding Program, a facility that allowed banks to borrow against their bond portfolios at face value rather than market value. This is a critical distinction. By 2023, rising interest rates had pushed down the market value of bank bond holdings significantly. The BTFP allowed banks to pretend those bonds were worth their purchase price. It was a confidence management tool and an acknowledgement that the banking system's balance sheet was weaker than its public reporting suggested. The Fed wound down the BTFP quietly in March 2024, without replacing it. The underlying problem had been managed. It had not been resolved. The second behavioral signal is the Fed's annual stress test. The scenarios chosen for 2024's tests included equity market declines of more than 40%, unemployment reaching 10%, and commercial real estate prices falling by 40%. These are not the stress tests of an institution that believes it is operating in a sound environment. These are the tests of an institution quietly quantifying how much pain the system can absorb. The Cyprus bail-in of 2013 illustrates what happens when that quantification meets reality. When Cypriot banks became insolvent, having loaded up on Greek sovereign debt, the EU's response was unprecedented. Rather than a taxpayer bailout, they imposed a bail-in. Depositors with accounts above €100,000 had 47.5% of their savings directly seized overnight. Not investments, not speculative positions, bank accounts. People went to sleep on Friday with €500,000 and woke on Saturday with €262,500. The EU subsequently formalized this mechanism as official policy across all member states. The United States has its own version, codified in the Dodd-Frank Act of 2010. The third behavioral signal is global. In 2022, the world's central banks purchased 1,136 tons of gold, the most since 1950. In 2023 and 2024, purchases continued at historically elevated levels. Central banks do not buy gold because they expect short-term price gains. They buy gold because it is the only financial asset with no counterparty risk, no dependence on any other institution's solvency, no exposure to any government's fiscal choices. When the central banks of Poland, Turkey, China, India, and Singapore are all buying gold simultaneously at 55-year record rates, They are not making an investment decision.
Oh.
They are making an insurance decision. And what they are insuring against is visible in every data set we have examined. The danger of the 2026 to 2028 window is not that one catastrophic event is scheduled to arrive. The danger is that for independent structural dynamics are converging in the same compressed time frame, and that their interaction may amplify each other in ways that no single policy response can manage. The first dynamic is commercial real estate. American banks hold approximately $1.5 trillion in commercial real estate loans, maturing between 2024 and 2026. These loans were made when office buildings were occupied and interest rates were near zero. They must now be refinanced at rates 3 to 4 times higher, against property values that have fallen 30% to 50%. In many cases, the new loan payments would exceed the property's rental income. The rational choice for the owner is to hand the keys back to the bank. When those keys arrive in bulk, concentrated in the small and mid-sized regional banks that power local economies, the resulting stress event could dwarf the Silicon Valley Bank collapse of 2023. The second dynamic is the Japanese carry trade unwind. For years, investors borrowed in yen at near-zero Japanese interest rates and invested the proceeds in higher-yielding global assets, U.S. Treasuries, U.S. equities, emerging market bonds. As the Bank of Japan raises rates toward normalization, those trades must unwind. Investors sell the foreign assets they purchased to repay their yen loans. In August 2024, a partial unwind caused Japanese equities to fall 12% in a single day. That was a partial unwind. The full unwinding of a decade-long carry trade has not yet happened. The third dynamic is the 18-year real estate cycle, documented across 200 years of Anglo-American economic history. The model points to a land value peak in approximately 2024 to 2026, followed by a correction phase. The previous peak was 2006-2007. The 2008 crisis followed. The cycle is not infallible, but it has been consistent for 2 centuries. Its mechanism, credit expansion, driving land price inflation, until credit tightens and prices collapse, is not a theory. It is a documented, recurring process. The fourth dynamic is the erosion of dollar demand. The 2024 expansion of BRICS, adding Saudi Arabia, the UAE, Egypt, Ethiopia, and Iran, represents collectively a meaningful share of global energy production. Every barrel of oil sold in a non-dollar currency reduces by a small but real amount the structural global demand for dollars that has allowed the U.S. government to borrow at lower rates than its fiscal position would otherwise justify. This erosion is slow, but slow erosion, compounded over years, becomes structural change. These 4 dynamics converge with the $8 trillion Treasury refinancing wall and the consequences of the rate pivot.
Ow.
No single one is fatal in isolation.
Ow.
But history's most damaging crises are rarely caused by a single factor. They are caused by the moment when multiple stresses arrive simultaneously, when the tools available to manage each individual stress are insufficient against their combined weight. The 2026 to 2028 window is that moment. In November 1923, a loaf of bread in Berlin cost 200 billion marks. The German middle class, the people who had spent a generation building savings accounts, purchasing government bonds, funding insurance policies, was wiped out in months. It's not the reckless, not the speculators, the careful, the prudent. The people who had done everything that responsible financial planning required. They lost everything because their savings were held in a currency the government was destroying. Every instrument of middle-class financial security was denominated in the same marks the Reichsbank was printing into oblivion. The wealthy, those who held real assets, foreign currency, gold, agricultural land, survived. Some prospered, purchasing distressed assets from desperate sellers for fractions of their true value. The transfer of wealth from the middle class to those who held real assets was total, rapid, and permanent. The political consequences followed. Germany's middle class, economically destroyed and institutionally humiliated, was psychologically available for something it would never have considered in the years of stability. Adolf Hitler became chancellor 10 years after the hyperinflation, in a country that had economically recovered but had never recovered its trust in the institutions that had failed it. On April 5, 1933, President Franklin Roosevelt signed Executive Order 6102. It required every American to turn over their privately held gold to the Federal Reserve at a fixed price of $20.67 per ounce within a year. Roosevelt revalued the dollar against gold at $35 per ounce, a 40% devaluation that transferred real wealth from savers to the government that had redefined their money. This was actual law, enforced by actual penalties, up to 10 years in prison for those who refused. The people who had read the warning signs, who had prepared for crisis by holding gold, had their preparation legally confiscated. In Argentina, in December 2001, the government froze bank accounts and limited withdrawals to $250 per week. Argentines who had spent decades building savings discovered that the system had unilaterally changed the rules overnight. The political consequences were immediate. 5 presidents in 2 weeks. A country with the agricultural resources to feed most of South America, with a highly educated population, with decades of institutional development, reduced to a barter economy in its worst districts. More than half of Argentina's population fell below the poverty line by mid-2002. Argentina has not fully recovered in the 25 years since. Now return to the United States of 2026, and to the 3 signs we have examined. The Federal Reserve's rate pivot in September 2024 confirmed what the yield curve had been signaling for 2 years. That stress in the financial system had reached a level requiring a response not from strength, but from necessity. The debt mountain, $36 trillion in national debt, $1 trillion in annual interest payments, $8 trillion in maturing bonds being refinanced at higher rates, and foreign buyers quietly reducing their exposure, represents a structural fiscal constraint with no precedent in American history and no clear political solution in view. And the Fed's institutional behavior stress tests contemplating 40% equity market declines. The problem, bank list expanding, central banks globally purchasing gold at 55-year record rates, legal frameworks for bail-ins quietly codified into law, represents an institution that knows what it knows and cannot say it publicly. What does a 10x wipeout mean for an ordinary household? It means retirement accounts that lose 50% to 80% of their value at the precise moment, age 55. Age 60, age 65, when there is no time horizon left to rebuild them. It means home values falling 30% to 50% in a market where refinancing is impossible. It means savings accounts and institutions whose balance sheets are weaker than their public reporting suggests. In a legal environment where bail-in is no longer theoretical, there are 2 differences between 2008 and 2026 that matter enormously. In 2008, U.S. national debt was $10 trillion. The government's response pushed it to $17 trillion, an increase of $7 trillion to manage the crisis. Today, starting from $36 trillion and adding $1 trillion every 100 days, the fiscal space for an equivalent response is a fraction of what it was. In 2008, the Fed cut rates from 5.25% to essentially zero, a 525 basis point cut that provided immediate, powerful relief to every borrower in the country. Today, that ammunition is already partially spent. This is the dark calculus. Not that collapse is certain, but that the tools available to prevent it are smaller. The load they must manage is larger. And the political consensus required to make structural adjustments is more absent than at any point in living memory. An empire does not announce its decline. It manages it with the language of stability, resilience, soft landings, and fundamental soundness. It manages the narrative right up to the moment the narrative can no longer be managed. And then the silence comes. The same silence that falls when people look at the things they are holding and begin to understand for the first time what those things are actually worth. The question is not whether that silence is coming. The question is what you are holding when it does.